Ladies and gentlemen, good day and welcome to the UGRO Capital Q1’FY26 Earnings Conference Call hosted by Elara Securities India Private Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Shweta Daptardar from Elara Securities India Private Limited. Thank you and over to you, ma'am.
Thank you, Anushka. Good evening, everyone. On behalf of Elara Securities, we welcome you all to Q1’FY26 Earnings Conference Call of UGRO Capital Limited. From the esteemed management, we have with us today Mr. Sachindra Nath, Founder and Managing Director, Mr. Anuj Pandey, Chief Executive Officer, Ms. Shilpa Bhatter, Chief Financial Officer, Mr. Sameer Nanda, Chief Revenue Officer, Ms. Ritu Singh, Senior Economist and Head Investor Relations. We express our gratitude towards the management of UGRO Capital to provide us the opportunity to host this conference call. Without further ado, I now hand over the call to Mr. Sachindra Nath, Founder and Managing Director, for his opening remarks, post which we can open the floor for Q&A. Thank you and over to you, sir.
Good evening, everyone. It is my pleasure to welcome you all to UGRO Capital's Q1’FY26 Earnings Call. We have been maintaining that MSME financing in this decade is the largest credit opportunity in India. And for us, every quarter solidifies its base. Q1 of every quarter for lending institutions start with a slower base. However, that defies how the year would pan out for us. This quarter for us had multiple milestones. We did capital raise of around 300 crores through right issue. We did a preferential allotment of around 900 crores where we saw our existing investor commit capital to us, and we will be utilizing the funds raised through for acquisition of Profectus Capital, which would increase our base to approximately 15,000 crore with a potential of improving our return on asset in FY27 with added profitability. Our share price has not been what we would like it to be. Raising capital at low valuation is neither desirable nor acceptable to us. However, in lending, between dilution versus maintaining the momentum of growth, we have preferred growth. We understand the importance of clearly outlining the levers that drive our growth, ROA and ROE, and our endeavor would be to explain that more over period. UGRO has been pivoting its asset engine to emerging market small ticket LAP and embedded finance in last 2 years. In this journey, we have expanded our footprint from 150 locations in FY24 to 309 locations as of June 25. This quarter, we are presenting to you how the build-out is happening. We believe on the current performance, when all our branches mature, we would reach monthly exit run rate of around 400 crore per month just from our emerging market channel. UGRO would be a very different financial profile company once we reach that scale. Our other lever of ROA is our embedded merchant lending business, which came to us through acquisition of MSL Tech platform, and we are presenting the performance of the same as well. This quarter, we also elevated Anuj as our CEO. He has been with me since UGRO's very inception. When we started the UGRO, the organizational design was to have a CEO for the business so that I can focus on strategic things which are investor interface, lender interface, organic and inorganic business growth opportunity, and CEO can focus on core operating performance. I am very pleased that our board have recognized Anuj's talent, perseverance and knowledge about lending industry and have entrusted him with this responsibility. I now turn to Anuj to take you through the quarter's performance. Anuj?
Thanks, Sachin. Good evening, everyone. The first quarter of FY26 was all about discipline and laying the groundwork for our next leap forward. Traditionally, Q1 is a softer quarter in terms of disbursements, and this year has not been very different. Especially in this quarter, we have tightened our underwriting filters, especially where borrowers' leverage was elevated and have moderated origination volumes in those pockets. This focus on quality has meant that even with slower disbursements, our growth trajectory stayed strong and our risk profile is stable. Let me walk you through our this quarter highlights. Firstly, on strategic action, we have announced a 1,400 crore all-cash acquisition of Profectus Capital, which is progressing well. Shareholder approval is secured and change of control and allied regulatory approvals are underway. Profectus has demonstrated stable portfolio expansion, building its assets under management to 3,468 crores as of March 2025, with presence across 7 states through a 28 branch network and over 800 member team, all while maintaining a gross NPA of 1.6% and a net NPA of 1.1%. Integrating Profectus school finance expertise unlocks 2,000 crores growth potential and strengthens our secured asset mix, accelerating our journey to become India's largest MSME lender. This acquisition will accelerate our AUM towards our medium-term goal of reaching 20,000 crores. On capital raise, as Sachin mentioned, we successfully completed 381 crores of rights issue and are in process of 911 crores of preferential issue this quarter. This capital combined has improved our capital adequacy ratios to 22.4%, which also ensures we can continue expanding without compromising quality. Now on business update. Our AUM closed at 12,081 crores, up 31% year on year. Disbursements for the quarter were 1,599 crores compared to 1,146 crores in Q1’FY25. The sequential decline from 2,436 crores in Q4’FY25 was by design and in line with our budgets. Our emerging market business expanded to 286 operational branches by June, with a clear path for more expansion by September 2025. These branches are now showing improving vintage profitability, validating our expansion strategy. In embedded finance, we crossed the milestone of 1,000 crore AUM this quarter. We disbursed 582 crores through My Shubh Life platform with a monthly disbursal run rate of between 100 to 150 crores, reinforcing our ability to embedded credit at scale with digital ecosystems. Portfolio quality stayed intact with GNPA at 2.5% and net NPA at 1.7%, well within our internal estimates. Our unsecured portfolio, though, has witnessed some stress on account of over-leveraging. As mentioned earlier, we had tightened our underwriting and have curtailed disbursements in last 2 quarters. 186 crores in Q1’FY26 versus peak 623 crores in Q2’FY25. Our total off-book assets stood at 42% of total AUM, supported by 17 co-lending partners. Total debt at 7,586 crores as of June 30, and with over 50 lenders, we have a very diversified liability profile. Our long-term rating is A+ rating watch with positive implications assigned by India Ratings. On financial performance, our total income grew 40% year on year to 421.8 crores. Our net total income stood at 216.5 crores, a 31% year on year growth. Our PAT came at 34.1 crores for the quarter, up by 12% year on year. Our credit cost was 47.7 crores, representing a 44% year on year increase, but lower than our Q4’FY25, which was 54.3 crores. ROA for our Q1’FY26, if we exclude the branch expansion impact, would be at 2.3%, which is in line with our internal estimates. Looking ahead, we expect disbursement momentum to pick up from Q2 as seasonal effects subside. The emerging market network is near full rollout and our embedded finance funnels continue to expand. The industry is currently facing higher stress in certain unsecured segments, but our exposure there is limited and ring-fenced. Approximately 70% of our book is secured and our underwriting filters are sharper than ever. We remain committed to building UGRO into India's largest small financing institution. Before we end, I would like to take your attention to slide 7 and slide 8 of our investor deck, which we have uploaded. This is specially inserted this time to highlight the traction which we have achieved in our focus emerging market channels. Out of the total 286 branches which we have currently, 150 of them are greater than 18 months old and 136 are less than 18 months old. And their traction overall from vintage perspective, we have explained that in the slide. So our AUM per branch for branches which have attained greater than 18 months is already touching 15.4 crores. For less than 18 months, it is currently at 3.4 crores. From business perspective, the average ticket size is close to 20 lakhs for a loan with an average yield of about 17.8 to 18%. Our GNPA for vintage branches is at this point in time 2.4%, well within the estimates, and for newer branches at this it is 0.2%. Similarly, for credit cost, for greater than 18 months, the average credit cost is about 1%. For newer branches at this point in time it is 0.3%. So out of total 286 branches, 121 branches have already broken even, and others in next 12 to 15 months are on the path of breaking even. We had also given a steady state estimate of once a branch becomes vintaged, what is the kind of productivity we can expect. And broadly, our internal estimates is that a branch should be able to deliver 1 to 1.1 crores of disbursal per month once it becomes stabilized, with a ticket size of 20 lakhs with a yield of 18%. In emerging markets, we only focus on secured business. We don't do any unsecured business at all. The distribution of AUM and branches is also very well diversified, with 48% of branches in North, 25% in West, and 27% in South. This is what I thought I should highlight, and now we are open to questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Anil Tulsiram from Best Pals Research Advisory. Please proceed.
Yeah, thanks for the opportunity. My first few questions are on embedded finance. I want to understand about the customer profile of this embedded finance product, whether it is existing to credit or new to credit. Secondly, is it a monthly EMI product or what? Third, in case of default, do we have any infra to collect the sum? So those are the few questions first.
On embedded finance, the way we have built it is to get embedded in a existing payment ecosystem like a PhonePe or a BharatPe, and through that get access of the transaction history of the. So typical target segment here is our small retailers or medium-sized retailers who use a payment ecosystem's QR code for their daily transactions. And the way we have built our business rule engine is to read the transaction history and compile it along with the bureau and other rules, statistical rules which we have made around. Typically, this is a daily repayment product and not a monthly EMI product with an average ticket size of less than 2 lakhs.
Got it. So, in case of default, do we do physical collections also, or entirely digital collections?
Players in the ecosystem now are also realizing that it is a very important component of their business, and they have started investing in very large field forces, both for distribution and collections. So in case of a default, there is a call center and a field force which is there to collect. In any case, the way we have designed this portfolio, we keep about 10% of the loans disbursed as a reserve pool for provision. So far, the portfolio, this is our 11th month, the portfolio performance has been very good, and the credit costs which we are seeing are about 3%.
Anilji, if I may add, the way you should think about it, among the top 5 payment platform in India, your top 4, Google Pay, we don't pay a partner, but between PhonePe, BharatPe, Paytm and Google Pay, there is roughly around 30 crore merchant, footprint we have. Now that 30 crore merchant footprint is not exclusive to each one of them, and obviously each one of them uses each other's payment platform as well. But the way the product is designed, so one, our technology embeds into the payment platform. They are the first point of origination, and they are also our collection agent. The way this works is that think of this, that there is a shopkeeper which has a daily transaction flow of roughly around 10,000. So what we call daily galle ka collection 10,000 rupees ka. When our machine runs the program, it looks at the daily transaction flow, then it pings the bureau, look at their historical payment profile, and then basis that it qualifies the customer for a certain amount of loan, but it ensures that the loan EMI should not be more than 20% of his daily collection. So if his daily collection is 10,000, the EMI should not be more than 2,000 rupees. And then you collect automatically from the system from his daily transaction flow. So that 2,000 rupees on a daily basis come back to us. So if the loan is for 2 lakh rupees loan is for 1 year period, the average loan would pay off in 6 months time, and that's why the risk associated that is much lesser. Second is that, as Anush said, that these products, while there is of the total gross yield, there is a distribution fee which goes to a PhonePe, there is a collection fee go to them, but we of the total yield we reserve around 8 to 10% of the yield as a provision coverage. We are seeing around 2.5% of credit cost, but net we get around 16.5%, of all the fully provided credit cost OPEX technology. That's why this has potential to deliver a 5% of ROA. Only thing is that you cannot make this as the only business, and that's why it's a percentage of the total portfolio. And that's in my opening remark I said that our EM platform and this have a massive ROA kicker possibility.
Got it, sir. And what is the target mix of embedded finance in next 2-3 years?
We would like to be around 10 to 12%
of the total AUM.
Of the total AUM.
Okay. Thank you, sir. I'll get back in the queue. Thanks so much.
Thank you. Ladies and gentlemen, a reminder to the participants, in order to ask a question, you may press star and 1 on your touchtone telephone. Ladies and gentlemen, in order to ask a question, please press star and 1. We take the next question from the line of Amit Agarwal from Water Equity. Please proceed.
Yeah, thank you. If I understood your opening remarks, you mentioned that around 70% of your book is secured. So what is the average loan to value for such properties or at origination, or what is the general cushion you keep on such secured transactions? And what are the type of properties you generally consider for lending? Thank you.
So at a portfolio level, our loan to value would be around 55%, while for prime secured loans, we go up to 80%, but at a portfolio level, this would be about 55%. And we do self-occupied residential property, commercial property, industrial property.
Amit, good to see you on the call.
Thank you,
Some
sir.
of our lenders so joining the call is very, very encouraging. Of this collateral which I will explain, if you look at our slide 6, it will give you a clear picture of, our asset mix and the type of the collateral. So in prime, we to take pure physical collateral, residential, commercial, industrial. In micro, predominantly it's commercial plus residential. In machinery, it is machine. In our digital alliance and, partnership, it is the first loss cover and high provision coverage ratio.
Okay, sir. So on slide 6, you are seeing that FLDG from partner is also a part of the security.
It's a kind of a collateral, yes.
Okay. And if I can just ask one more question, because this pertains to, it may affect you, and you have given a separate slide on the new co-lending guidelines. So do you think, do you think as a positive or a negative at a general level, and how much, you see effect on your company going forward from January? So one can be industry level, your comments, and one the company specifically, if possible. Thank you.
So there are two parts of it. Half glass full, half, empty. I think so. Well, let me talk about the positive first. So one biggest positive is that now co-lending, all form of co-lending in India have now come under regulatory umbrella. So as you know, NBFC to NBFC co-lending was not within any regulatory framework. So now the co-lending has been, coverage has been given to two regulatory entity can do co-lending, and that everything has come under that umbrella. Second big positive is that RBI for the first time has allowed first loss cover to be given to the bank. Now some people think, how can that be good? I'll tell you why it is good. So today, if a State Bank of India or a large NBFC is a co-lending partner, they have to carry the risk of the total co-origination co-lending which they do. Now, because of that, they charge a certain amount, they presume certain amount of risk and they charge a risk premium, and that becomes our net rate. Now, we report everything on an AUM basis. We are comfortable with our credit cost. If you go to a bank and say that now, if suppose in our secured business, our expected credit cost is around 1%, and if we gave them a 2% of or 3% of a first loss cover, volume would increase multiple fold. So that is a big positive. And because of that, of FLDG, our net cost in co-lending would come down. And also, obviously, it is a business without capital. So the advantage with larger players, the AAAs and parent-owned entities have is entities of leverage. So, second largest NBFC or third largest NBFC in India is levered 8 times. Now we get leverage of only 4 times. But now this will give us the capability to actually lever us, very similar without actually putting capital behind it. So I think it's a very ROE positive move. And last but not least, not relevant to us, that the co-lending was only applicable to priority sector lending. Now it is open for all. So actually any class of asset can be done, while our assets are only priority sector. Now the challenges. So I think so. We have industry as very strongly represented to the regulators. They have heard our voices and they have made adjustment from draft to the new guideline. My view is that from January to 2 quarters, there would be disruption to reset the new process. The biggest the challenges would be that now we have to select our co-lending partner at the point of origination itself. I don't think so. The technology is a challenge because in most, at least in our case, with most of the banks, we are fully integrated both in, simultaneous lending and, post-disbursement transfer of loan lending. So that is not a challenge. I think so that would be fine. But at the point of today, when we do co-lending, we don't look at which bank the loan would qualify. We disburse from our balance sheet and then we test which loan case would fit to which bank, and it goes there, and then they test it on their policy in process, and then it gets transferred to them. Now our distribution architecture has to change, that at the point of origination we have to choose that where this loan would get qualify, and we would need the corresponding bank to also say yes, and the loan documentation would be accordingly get triggered. And bank then would still have the time to take 15 days to the loan to get transferred to them. So it is, little bit of tweak from our original process, but it is not insurmountable. So on the balance of capacity of volume increase with the FLDG and the process, market expanding in big way. I think so with little bit of 2 quarter of, adjustment to the new, the overall industry volume and our volume should multiply from where we are today.
Okay. Thanks for the detailed explanation. Thank you so much and all the very best.
Thank you.
Thank you. We take the next question from the line of Rishi from Lavish Ventures. Please proceed.
Yes, hi. Mr. Can you hear me?
We can.
Yeah. Hi. Good afternoon, and congratulations to Mr. Anuj for his elevation as the CEO. Mr. Thank you again for coming on national television to explain the acquisition of Profectus. I just have a quick question on, the trying to understand the management's thinking about inorganic growth. So I understand that it's going to be a secured mix that's going to improve the portfolio mix and probably bring down the cost of borrowing. But the point that I would like to understand is it seems like a tactical solution to hit the ROA that we initially wanted to hit. So how does the management see further or future inorganic growth? Do you think you will always be open to such growth opportunities, or is this a one-time thing and you're now just going to focus on the business as usual?
Yeah, very good question. Thanks for this. So look, we have never focused on any inorganic ever. We have always focused on organic business, and that continues to be our philosophy. I don't think so that going forward till the time, we are fairly valued, we would have the availability of capital to look at something. While, everything which is there available, we obviously evaluate it, but there's hardly any fit which we find. So my reasonable estimate is that we would not be doing more acquisition, unless something very attractive comes that, which can, improve our finances dramatically. On your question, so why we did this and whether it is tactical or is a long-term strategy, to be fair, it is more tactical than a long-term strategy. There was a little piece of long-term embedded into that, but it was more tactical for us. In our steady state basis, our journey from our current ROA to 4% ROA, has a time period, and that is largely a function of our, emerging market business and their branches getting to a certain level of volume, our portfolio yield increasing because of that volume, and then, that hitting an ROA. When we were supposed to raise the capital because we had to supposed to maintain certain amount of capital adequacy. Having raised that capital, whether to deploy that capital over a period of some time and build portfolio, or whether if there is an asset available which can actually improve our ROA in shorter period, we choose that. It doesn't impact our capital adequacy. Our capital remains the same because we have acquired it more or less near book value. And we felt that it improves our asset mix. It gives us a line of business which is school financing, and obviously it has multiple other things, like portfolio quality, asset mix, so on and so forth. One way to look at it is that, we were rated India rating A+. When any acquisition happens, ratings goes into a watch. India rating, when they looked at the numbers, the watch, from a stable outlook, we became positive outlook. What does it mean is that what the acquisition, probably from a rating perspective, is a positive because they saw that our, financials number, portfolio quality would solidify. One of the biggest input to our ROA journey, which is less in our control, is our cost of borrowing. Our cost of borrowing vis-a-vis our peer set has remained elevated. It's roughly around 150 to 200 basis points more than most of our peer set. Larger peer set obviously is much higher. But even if you look at A+ and AA- rated entity, our cost of borrowing is definitely high. It has remained high because we have been a very high growth company, which means on a month-on-month our borrowing profile, we borrow a lot. And when you borrow a lot, obviously you have to pay a price for that. So this acquisition also helps us in that because we have achieved our numbers purely from an AUM perspective, profitability perspective. Now we have an advantage of to play how much more organic disbursement we can do. So we will play of growth versus bottom line and reducing our cost of borrowing. So on these three spectrum, I think so this qualified well, and that's why we did this.
Okay, thanks for that explanation. To me personally, I was thinking that such kind of an acquisition would be done by companies who are desperately, trying to meet the street estimates. And given that we are not valued anywhere close to our actual worth is, I thought, why do it to satisfy actually nobody who is, watching us so closely to either bring the price down or up based on the acquisition. And to be frank,
No.
I would share the same comment that you mentioned as well.
Sorry to intervene with you. Obviously, it's very close to my heart. So look, beyond a point of time, it's, how the street looks at it and whatever price is under our limited control, right? What our job is, what we are interested is that what we think, how do we build, we explain it, well to people. Sometimes people accept it, sometimes don't accept it. We are confident that what we are building would get value. But in what period of time we don't control. Whatever action we take it purely fundamentally of whether it is good for business or not. One of the ways the street would value us over a long period of time is when we improve our operating metrics, right? So the constraining factors are constraining factor. We don't have a parent, and that's why we don't have the same cost of borrowing as, large parent-owned NBFCs have. We have a cap on leverage because that's the way the lending market works. Within that two constraining factors, we have to improve our portfolio yield, we have to control our credit cost, and we have to demonstrate consistent growth. We felt that Profectus acquisition fit on those criteria, and that's why we did that.
Thanks again. One final question, if I may. Could you just talk very briefly about the exits of Mr. Amit and Kishore, if you would?
Yeah, of course. Why not? Look, UGRO is a growing organization, and over a period of time, if I always go back in the history. If you look at the evolution, even banks like HDFC Bank and ICICI Bank. In a growing organization, people definitely commit themselves to build certain things which they are interested with. And, when there is, they see that their role is over and they are getting a better opportunity of what fits to their profile, obviously they will choose that. Now, we as management, as a company, actually feel that it is important that people come here, stay for a reasonable period of time, if possible stay for life over here. But if they get the opportunity, then they should choose those opportunity and go for that. What is important for the company that we should have talent embedded which can step up and fill those vacancies without disruption to that business. Amit, from here, if you look at, we are gratefully thankful to him. When he joined UGRO, we were roughly around a 1,500 crore of asset organization, and he delivered almost 12,000 odd crore. But he felt that his skill set, and because he came from a background wherein large scale intermediated distribution business was his core skill set, and he felt that an opportunity of similar size, similar place with a much larger scale for his residual professional career is in interest, and we said that. But what he has put up here and what kind of talent he has built, organization will continue to do well. So it is in both interests. On CFO, again, it's a personal choice. Obviously, a CFO role in UGRO is a difficult role. If you look at the banking financial services industry, majority of the easy lending from mainline banks is to entities which are either have a parent or have a vintage. And sometimes UGRO has a very deep diversified lending base. So you have to not only interact with the global DFIs, you have to interact with private sector bank, public sector bank, public market. So it's a hard job. And sometimes people make personal choices that for the same time and impact where they can deliver more. But there also, we had, very capable, succession pre-planned. Shilpa was already appointed as a deputy CFO. When Kishore, shown his desire, to go to other organization, she was already immediately elevated as a CFO position.
Thank you, Mr. Nath. If I may, can I just ask one final question, and I'll jump back into the queue. So is the warrant that are possibly going to expire out of the money. Can I confirm that the actual, given that they are the same for the CCD buyers as well, can I confirm that the price for them is the 185 plus the 62 that they had prepaid 18 months back? So overall, they are doing it at 247 minus the 12% that has been rebated.
Sorry, I couldn't understand the question, but I tell you what is. So the warrants were issued at price of 264, right? And all the investors had paid 25% of that as their initial contribution. Now the warrants are deep out of money. When the company needed capital, we had a choice to go and raise the capital either from new investors or raise the capital from the same set of people who had put money through the warrants. Now we felt, because obviously when you need the capital, given the public market is not very widely open, if you go to private investor, the time it would take for private investor to put capital can sometimes be very elongated. And that's why we felt that the good choice would be to go to existing investors who have put money on the warrants and request them that whether they can put capital on the current traded price. The way we structured it, we said that you come at 185 rupees, which was that time the SEBI preferential pricing formula. We paid a coupon, which was 12.5% upfront coupon, and we linked the second coupon to the exercise of the warrant. So if for some reason share price in the intervening period moves and the same investor want to exercise the warrant, then they don't get it. They get only 12.5%. So that's why the effective price for them becomes 162 rupees. So from a company perspective, what we said that given that if we were to forfeit the 25% and if we were to pay 25% at a balance sheet level, it is a zero impact on us, and these investors are getting new shares at 185, which otherwise any other investor would have got. In order to be fair to the balanced public shareholder and because there was a dilution happening at a lower base, we calculated the total dilution. That was an extra 4% dilution between 265 and 185. And that's why we did a right issue of the matching 4%, which came out to be 400 crore. We took the effective price of 162, which was 185 minus 12.5%, and made a right offering at 162. And that's why, of that, some of the existing investor, IFU, which is Denmark government, committed 150 crore. Some of the other investors put money in the right. And also, contrary to our expectation, we saw quite a bit of public participation, and that's why right went to up to 380 odd crores. We could have done a smaller right issue, but we did matching right issue to the dilution. So there was a 4% extra dilution happening between 265 to 185, and we made the size of the right issue exactly there. So it was very, well debated, both at our board level and as well as external advice, and that's why, to be fair to every public shareholder, this is what we did.
So my question was basically the 162 plus the 62 that they've already paid. So their effective cost is 224. If they don't exercise the warrant, they lose the 25%.
Yes, that's right.
Okay, because this was not clear in a lot of public forums. There was a lot of noise around why it was 162, and I was trying to explain to them that it is actually 224. Thank you very much. Yeah.
Okay, thank you.
Thank you. We take the next question from the line of Deepak Yadav, an individual investor. Please proceed.
Yeah, hello. Hi. Can you hear me, sir?
Yes.
Yeah, okay. So I want to know where the net yield going to be stabilized. So I think they are increasing since last 1 year or so. And so where do you see the net yield going to be stabilized or going to go by the end of financial year 26? And also, what are the interventions you are doing to decrease the cost of borrowing? I heard somewhere that you mentioned on the national TV or the last earning call that you would decrease the AUM growth, like organic AUM growth, so that you need to take less of credit or loan, and this would motivate the lenders to give you less money at less cost. And also, at last, I would like to understand where do you see the AUM and ROA number at the end of this financial year? Thank you.
our net yield increase is a function of the increased contribution of our emerging market business and embedded finance business. So our emerging market business at end of March 25 was about 22% contribution to the overall portfolio, and we want to take it to around 35% by end of the year. So while we are not increasing yields in the segments which are already running, we are just increasing the contribution of segment where yields are higher, and hence because we don't want to take unnecessarily adverse credit selection risk in prime segments. So we foresee the yields to go up by 0.25 to 0.5% in the coming year. So that was number one. While the ROA trajectory in the longer run, and we have talked about that earlier as well, is that at a steady state we want to reach 4% ROA levels. With Profectus acquisition and the operational leverage which we are getting because of that, added to that our cost of borrowing advantage which we foresee should start happening owing to both the macroeconomic factor and our scale and size increasing, and a little bit on OPEX to AUM coming down with our emerging market branches with having more vintage playing out. We foresee in next 6 to 8 quarters to reach where we want to be. In the interim, for about a year, so it would increase on a steady state level each quarter about 0.2 to 0.3%. That is what the estimate is.
I think you mentioned about how we will bring down the liability cost, and you might have heard it is a choice between growth of AUM versus liability. So let me clarify. What we believe is that within our peer set, and I'm not comparing to entities whose cost of borrowing is predominantly basis their parentage. I'm talking about the entities which are similar to our profile, which is similar to our rating band, and our cost of borrowing is little elevated to them. It is purely a function of our growth rate. I don't think so that I have come across an entity which in last 4 years have grown from roughly around 2,000 odd crore to straight 12,000 odd crore. So in lending, when your net monthly borrowing is very high, then obviously your flexibility to negotiate cost of borrowing is very, very limited. We have reached to a level of maturity wherein for us improving our cost of borrowing is a paramount, and that's why I say if it were to be the case that we have to make a choice between growth versus input to our business is cost of borrowing, we will choose cost of borrowing, and if required we will reduce the growth rate. It doesn't mean that we will not grow at the pace what we are growing. Fortunately, we have added 3,000 crore of AUM every year in last 3 years. Now with Profectus, we actually added that 3,000 crore AUM, with the acquisition itself. That's why we have more flexibility to focus on our emerging market business, improve the portfolio yield by improving the funnel, perfect our embedded financing business, maintain the volume in our prime and machinery segment, and we think that with the overall improvement of profile, our cost of borrowing would improve from where we are.
Yeah.
Hello,
Thank you,
Mr.
sir.
Deepak.
Thank you for the answer.
Thank you.
All right. Thank you. We take the next question from the line of Anil Tulsiram from West Pals Research Advisory. Please proceed.
Yeah, sir, my question is on the emerging market business. So I'm just trying to understand the ticket sizes and the interest rates. If I see our peers, they are lending 10 to 12 lakhs at 16 to 17%, and our average ticket size is 20 lakhs, but we are lending at 18%. So what sort of customers we are?
Sorry, can you define what means a peer? What do you mean by that?
See, I look at the HDFC Finance, their ticket size is around 10 to 12 lakhs, but their average interest rate is around 16%.
Yeah. So I think purely on SBFC, you are comparing this, there are 2 points. You are comparing that they combined with their gold loan business. So we are not in gold loan at all. So you should segregate our portfolio versus their portfolio on micro LAP perspective. The market. So among the listed peers, majority of the players which are focused on micro LAP and also unlisted player largely are below average ticket size of 4 and 5 lakh rupees. And the average yield is also little higher. The SBFC yield might be, and I don't have the access, I don't remember their numbers so well. And I presume the blended it will be little lower is because of the total combination of gold plus micro LAP. So leave that aside. Majority of other player in the south, which is now similar size, where average ticket size is 4 lakh rupees, but the portfolio would be now used to be around 24%, now coming down to 22 odd percent. We have maintained that when it comes to emerging market LAP, our expertise and capability is not to go into that lower ticket size. We in last 2 years have also maintained that smaller ticket LAP is adjacencies to microfinance, and in that cycle, the total credit cost can get elevated, significantly. UGRO as a company has expertise to do, prime LAP all the way up to 3 crores, average ticket size of 80 lakh. We have capability to do machinery business. We have a data analytics plus technology platform. So when we graduated to emerging market LAP, we decided to do only up to 7.5 lakh rupees. But our competitive advantage vis-a-vis any other player that we can also do larger ticket loans in tier 2, tier 3 towns. So when we do our EM platform or EM channel, we can do secured loan up to 1 crore in a tier 2 town, where average is now coming to 20 lakh rupees. So at the 20 lakhs, I think so we are being able to maintain a better yield than some of our peers. So most of the micro LAP players are at blended portfolio yield would be around 22 to 23%. Ours is, because it's 20 lakh is what it is coming today. Anuj, you want to add something?
No, this is fair. And this has been a process. When we started, we focused only up to 50 lakhs in our emerging market branches. But we also realized that there is a small pocket of larger ticket size customers there. And we had already developed that expertise in our prime segment. So we have transitioned that expertise in our micro, and that's why our overall ticket size is increasing a little bit. But we don't mind it, because at a portfolio level, it gives a lot of stability.
Got it. And coming to the co-lending, there is a new wording, something called blended rate, which NBFC and banks have to follow. And there was a note by ICRA at the time of the draft guidelines. It says that this blended rate will reduce the interest rates, which ultimately NBFCs are able to charge, and the resultant ROA. Can you explain this, please?
No, so sorry, what is the note on ICRA? Sorry, what is the question?
No, so see, earlier there was no compulsion by the RBI that the rate which NBFC charge has to be blended rate of banks and NBFCs. NBFCs decide their own rate, but now the interest rate which NBFC charge to the customer has to be the blended rate of the banks and NBFC. So following this blended rate methodology will reduce the interest rate which NBFC will be able to charge to the customer for the same product compared to the earlier guidelines.
Is that ICRA? I have not seen it. Is it an ICRA comment saying that NBFCs won't be able to charge this thing?
Yeah, I can forward you their earlier note actually.
No, of course I will go and search it. So sir, first the blended rate concept was in the 20th November 2020 circular as well. The challenge of the problem was that because loan was first originated by NBFC at its rate, and that's why that became the rate. And the co-lending partner used to give it a fixed rate, and the differential used to come to NBFC. But what rate NBFC charged at the first point of disbursement was the blended rate itself, right? Only thing what was not disclosed to or known to the customer, that at what rate a bank has lent and at what rate the NBFC has lent, right? Now think of a new scenario wherein RBI said that you have to disclose to customers that what is the rate at which bank is coming and what is the rate at which the NBFC is coming. Now, if suppose there is a loan which need to be charged 15%. Why it is charged 15%? Because NBFC will have everything. The entire cost of origination is NBFC's cost. Entire cost of collection is the NBFC's cost. Now the credit cost is also NBFC's cost. So when NBFC will price its portion of the loan, it has to also, factor in its total cost, and bank has to factor its cost. So bank would have actually no cost other than to disburse. So accordingly, the blended rate, the NBFC portion would go higher and bank portion would come lower, and that would become the blended rate. Some transmission would surely happen. I don't think so this would shrink the margin of the NBFC, but the pricing which bank would give would be lower than what it is giving today, and some transmission would keep going to the customer, which is also RBI intent. RBI intent is that the lower cost of bank lending should get transferred to the customers. We will see how that transition happens. We don't see that would shrink the margin for NBFC in a very significant manner. Some of it is evolving place. We'll see how it plays out, and probably by next quarter we are also studying. There are consultations which are happening with RBI as well. We'll get more clarity around it.
Got it. So then the last question is on the collection infra for the emerging market. So over the last 12 to 18 months, stress has emerged in the various segments. So have we changed our collection infrastructure, enhanced it, or anything which we have done to strengthen our collection infrastructure?
Yes, and it is part of our design itself. Each of our emerging market branch is a templated branch where there are 5 to 6 front-end sales resources, 1 credit resource, 1 operations resource, and 1 branch head. And after a certain AUM, approximately 2 crores, we also have a collection resource. So today, out of the 300 branches which we already have, we have close to 300 people on the ground, exclusively focusing on collection. So as our emerging market branches have expanded, so is the collection infrastructure.
Got it. And sir, one last question is on the collection infra for your embedded finance. See, in China, the Ant Financial has its own collection agent, what I understood after reading the prospectus. But in India, these payment gateways which you spoken about, PhonePe, these people are not maintaining any collection agent while they are engaging in the loan. So how do you see this risk?
No, they are actually, they have started investing a lot on their own collection infrastructure, because unless the portfolio which gets sourced through that ecosystem, unless there is a collection intensity and the portfolio performance, the business will not scale. And most of the partners, large partners now understand that and are now investing in that.
Got it, got it. And sir, this embedded finance is only for business purpose, right? It is not a personal loan for the consumption.
No, we don't do buy now, pay later. We don't do PL. UGRO is a 100% business loan company. We only give loan to a Udyam Aadhar registered MSME customer.
Got it, sir. Thank you, sir. Thank you and all the best. Thanks a lot for all the answers.
Thank you. Due to time constraints, we will take that as the last question and would now like to hand the conference over to the management for closing comments.
Yeah, thank you. Thank you very much. If you have any further questions, please be in touch with Ritu. We'll be more than happy to explain. Our continuous endeavor is to deliver consistent growth, consistent performance. But we continue to believe that certain pockets of the market would show some amount of stress. We have been anticipating that, and we have pivoted, some of our asset engine accordingly as a proactive measure. That's why we think so that we are in much better state than many of other competitive players, and we'll continue to focus on building what we are tasked at, and continue to explain you in detail what we are trying to do. Thanks all for putting your time to listen to us. All the very best.
Thank you. On behalf of Elara Securities India Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.